Hey guys, I'm John Brown. I'm with Keller Williams. I'm a realtor, and I'm here with Greg Cutt with Guaranteed Rate. He's a mortgage banker, and I'm interviewing him here to just clear up some air on these crazy times within the mortgage industry. So. Yeah, I mean, I've been hearing a lot about the Fed cutting interest rates to zero. Can I get a mortgage rate for that low, or how does the Fed rate affect mortgage rates?
Well, when the Fed cuts the rate, they're cutting what's called the Fed funds rate, and that's the rate that the Fed will lend money to banks for. Um, and they recently cut that rate to between 0 and 0.25%, which is a historically low number for the Fed funds rate. Banks are always borrowing money from the Fed. And so when the Fed cuts their rate, it means that the banks can borrow at a lower rate from the Fed, which means they can then lower their rates on things like car loans, credit cards, student loans, home equity lines of credit, things like that. But unfortunately, it does not necessarily mean that mortgage rates are going to come down when the Fed cuts their rates. Mortgage rates are based on economic factors and not necessarily what the Fed is doing. So things such as unemployment, inflation, gold prices, oil prices, those types of things impact mortgage rates. Now the news does love to say that mortgage rates have dropped every time the Fed does cut the rate. And at that point, I get a lot of phone calls from people asking if they can get a 0% interest rate on their mortgage, and that's not the case. Typically, it'll help the adjustable rate mortgages, or ARMs as they're referred to. It will bring those rates down a little bit, but it won't impact a 30 or a 15-year fixed mortgage.
Okay, that is good. And what rates are you seeing right now? I know we'll get into different volatile, different rates, but what around can you expect?
Right, for some loan amounts, we're seeing rates as low as 3.375 on a 30-year fixed, which is extremely good. So there are some great rates out there at this point. But there is a lot of variation between loan amounts. And so there's also rates as high as 4.5% out there. So it's a widespread.
Nice. Could you touch base on the different rate limits and refinancing and how those are affected right now?
Sure.
Like what you were talking about?
Sure. So normally interest rates on a purchase or a refi are about the same. But
normally.
Yeah, that's normally. And things aren't normal at the moment. About a month ago, rates really dropped, and a 30-year fixed was 3.25%. A 15-year fixed was 2.75%. And so a lot of people started refinancing to the point that lenders got inundated with so many loans that they couldn't handle the volume anymore. So they needed a way to slow down the volume. And the way a lender does that is they increase the interest rates. And that's what happened all over the country. So we saw rates go from 3.25 to literally within a day or two up to 4%. And that definitely did kind of help to put the brakes on things and slowed things down.
Yeah.
Now things have gotten a little bit better. Like I said, those purchase rates are back down to about 3.375%. But we're seeing the refinance rates more like 3.75, 3.875. So there's definitely a fairly big spread between the two.
Okay, nice. Well, that clears it up. With everything going on, are lending guidelines changing? If so, does that affect people who are self-employed more than a W-2 salary? wager?
Sure. Yeah, in the last few days, we've seen the lending guidelines get a little tighter. And that's for people that are self-employed and people that aren't self-employed. But I feel that things are going to be tougher on a self-employed borrower because with the economy being shut down the way it is, a lot of self-employed people they're going to really see their income drop. And when we do a mortgage, a lot of times we are asking for what's called a profit and loss statement to see what their income looks like currently. You know, we look back in the past couple of years to see their income, but we also want to see what does it look like today, and that's what the profit and loss is used for. And of course, we're going to see a lot of people where their income is way down, and lenders are going to look at that and say, okay, we understand that it's because of the coronavirus. We get that, but the concern will be, how long will it take for your income to go back up to the level that it was before the coronavirus? And there's no way to know that, and lenders do not like uncertainty. And so my concern is that lenders will say, until we see a pattern that your income really has increased, they may not lend to self-employed borrowers.
Even with a crazy loan-to-value ratio?
Even with a crazy loan-to-value ratio. It doesn't, you would think it would help a lot, but it doesn't help that much. The other things that we've seen, with the conforming loans, and those are loans to Fannie Mae and Freddie Mac, the guidelines have only changed a little bit, so people aren't going to feel much of an impact with those changes. The bigger impact is on the jumbo loans, so higher end loans. They have already increased the amount of down payments required. They've increased the credit score requirements. They've also stopped doing loans on rental properties, and they won't do cash out refinances anymore. So they've definitely made some substantial changes already.
That was in the jumbo?
Yeah, on the jumbo. Hopefully things will go back to the way they were when things get better with the economy, but it's hard to say.
And clear up, I guess if people don't know what a jumbo loan is compared, brief.
The easiest way to put it, so conforming loans are the loans that are backed by Fannie Mae and Freddie Mac, the government agencies that basically handle all the conforming loans. And they have loan limits that once you're above what the loan limit is for a conforming loan, you are then in jumbo world. And those, it depends on county a little bit. In Summit County, jumbo loans start at loan amounts above $760,000.
Wow. And did that change recently, or is that still the same?
That's still, it changed. Every year they change at the beginning of the year.
Okay.
So every year.
Then it went up. But it didn't go back down because of this.
Right, it has not gone back down because of the problems that we're facing today.
And then, for someone that has been sitting on the sidelines, waiting for a recession or some sort of, buying opportunity, how does the buying power of a lower rate compete with getting a good deal if prices do drop lower? Is there like a magic number or a set guideline that you know? Or
I mean, there's a formula on how to calculate, what an increase or decrease in the interest rate does to your loan amount. So, like a rough rule of thumb is that a 1% decrease in the interest rate increases your borrowing power between 13 and 14%. And so to put that in perspective is if A person who qualifies for a $750,000 loan amount at a rate of 4.5%, they can qualify for an $850,000 loan amount at a rate of 3.5%. So that's $100,000 difference in what they can borrow.
In 1 point.
With 1 point?
Yeah.
Right.
And not too long ago, we were seeing in the fours, so.
Right.
So that is some, opportunity there for sure.
That's true.
If you had a crystal ball.
And I do.
You do have a crystal ball. So with your crystal ball, where do you see this in 60 days and possible year end? I know you don't have the crystal ball and the virus, but
right.
Yeah. What do you think?
Yeah, I mean, I anticipate that we're going to see interest rates get a little better in the future. The tough part is how long that's going to take, and a lot of it's based on when the coronavirus issues are cleared up and the economy starts to get back to normal and markets get back to normal. And when that happens, there are a lot of people that feel that the rates are actually going to come down a little bit, especially on loans where the rates really did jump up. A rate that's 3.375 now, there's not a lot of room, but where rates, did jump up into the 4% range, that's where I really think we're going to see those come down. But yeah, it could easily be 6 months until things really settle down again.
And is that contributed to more people buying mortgage-backed securities because they feel safe in doing so? Or
yeah, that factors into it.
Yeah, I mean, there's probably so many, but that's one of them.
Yes.
Nice. Well, I hope everyone viewing got a lot of value out of this. I know I learned a few things, and thank you very much for that. And thanks, Greg Cutt. And
thank you, John.
Yeah. All right. Air high five. Boom. All right. Stay safe, guys.